for us on the development side, we realized, look, we're getting construction quotes, let's say 6.5%, 7% or whatever. We know that our construction costs are going to be about, I don't know, let's say for argument's sake, 70 to 80% cost of the value of what our properties are worth once we stabilize them. So it's a smaller percentage than what the properties are actually worth when we refi out into stabilized debt. And then we model this stuff with conservative rent increases. So we know that by the time we stabilize in 3 years, the whole world's going to look different. Right? We can't live in this moment. You have to be cognizant of this moment, but not live in this moment. And so we model all this stuff knowing that interest rates are going to fluctuate, but our overall interest rate is probably going to be lower than where we see this peak coming. And the other thing is too, at least in our class, I mean, we're building luxury class, infinity pools, Zen gardens, e-bikes, shared cars. I mean, we're state-of-the-art amenities. We know that the average household income of our tenant base, say $90,000+ a year, isn't going to have as many issues with the way this economy is today, especially when interest rates stabilize and inflation gets under control, as maybe let's say the working class perhaps might be in our C or B class properties. So it's a different animal. You just have to underwrite and stick to your underwriting and be conservative and just make sure you raise enough capital. But what's interesting about this construction space is, the private equity and the banks, they want to be in this space. I mean, these are amazing properties. We already have some offers, pre-offers. We haven't even broken ground. Our first one's breaking ground in February, right? 1 of 6 properties. So, I think everyone just has to educate themselves and just, follow your numbers.